Hi everyone, so today we'll do a stock analysis on Domino's Pizza Enterprises Ltd, ticker DMP.AX, and it operates retail food outlets, so it's a pizza chain. So if you want to contact me, you got like Discord, X, and email. So if you have any question or just want to chat, just go to these places. Quick disclaimer, I'm not a financial advisor. This is my own research, up to you to make your own decision. So in this video, we're gonna go through like the usual summary with a company profile, with description, looking at the brand, the stores, franchise or corporate, looking at the product they sell, the director's activities or what's been happening in there, and then the insider ownership. Then we're gonna go with the fundamental analysis, the usual stats, 4 years of chart analysis, and talk a bit about the debt dividend. Then we look at technical analysis and finish with a price catalyst and a conclusion. So let's start with the company profile. So Domino's Pizza Enterprise Limited operates in retail food outlets, so selling pizza. We're gonna show later what they are. Then it has franchise rights for the brand Domino in like Australia and New Zealand, part of Europe like Belgium, France, and others, and then Asia as well with Taiwan, Malaysia, and Singapore. So the company was founded in 1983 and is based in Brisbane, Australia. So this is not the same as DPZ, which is a Domino's pizza brand that is more focused on the US. So do not mix up this one with the DMP.AX, by the way. So here is what they sell. So usually they do like pizza inside and like drink and like some package, and you can pick up at the store or you get delivered to your place. This is usually how they work that out, and they have usually stores in almost everywhere. So like especially for big cities, you can always order pretty much anywhere and get delivered to your house. That was pretty much the way they used to deliver pizza before that Uber Eats came. But yeah, so that's pretty much it. So now let's talk about franchisee versus corporate stores. So first of all, we have the franchisee stores, which means that an independent business owner franchisee buy the right to use a company's franchise or brand and business model. So in terms of Domino's, we have the brand Domino's, that is the franchisor, and then a business owner will come to Domino and ask them to use their brand, so that business owner will be the franchisee. Then the benefit of that is that it's an established brand, which means that the brand is already known for the franchisor, so Domino's people already know what it is, what they're doing. So then the proven model, so we've seen already franchisee having success, so they believe that they can have success as a franchisee as well. Then we have the support, so it gives all sort of like branding, menu, like all the tools that you need to make those food. And then as well, if you have any problem in the store, they might be able to somehow help. Then we have a rapid expansion, so for the brand it's actually much faster because you don't need to borrow to then expand with like corporate store. Then the drawback is loss of control, so you may not be able to have the consistency on the branding, so it could have an impact on the brand. Then we have the fees, so it could be high, and then for example a business owner, franchisee is not able to become profitable after those fees, so you have to have the right balance between the franchisors and the franchisees fees so that they can both work together. And then you have less autonomy, so that means that the franchisee is not able to just sell something else, like for example Asian food or something completely outside of the branding. Then the other case is a corporate store, so this one is more simple. So the parent company actually directly owns the stores. The benefit is that they have complete control, obviously, so they can do whatever they want, change the new menu, the old one, and then impact on all their stores. And then the brand consistency, which means that they can better control all the stores because they own them. And then the full profit, they don't need, like, because they don't have the branding cost, they can, whatever they make is for themselves. The drawback is the fact that it's higher cost. So to expand, if you want to have more stores, you have to invest, like, or rent a local or even buy the local. So it takes more debt, and it takes as well a greater risk, because the more leverage you are, the more risk you take. And then it's slower expansion. You can't open hundreds of stores in 1 year if you only have 5, because of the debt you will need is too high, for example. So here is a slide where you can see like all the stores they have, the network. So in total, so I just got a summary in here. So there is like approximately 726 corporate store, which is approximately 20%, and 2,803 franchisee store. So in total 3,736, and there's like 80% franchisee store. In terms of the how it's diversified, so then we have like ANZ, which is Australia, New Zealand, which represents 7% of corporate, and more than 80% in franchisee. We have 891 store. Then in Europe we have 5% corporate and 95% of franchisee with 1,345 store. And then in Asia 1,293 with 46% corporate. So as you can see, there's way less franchisee in Asia compared to Europe and Australia and New Zealand. And I would say that that's the major difference. And I would say that there's very few corporate store in actually in Australia and New Zealand and in Europe. So yeah, that's interesting. So in terms of the directors of the company, there have been a lot of going on with the directors in 2025. So we have 2 news from Domino's that says on the 2nd of July 2025 that which one? So Mark Van Dijk, I'm not sure how to pronounce it, has been actually like left the company. And then there's another, so it's Jack Cohen will be the one replacing him in a short term, which is actually one of the biggest investors we see later. So that Cohen there, and which has been since 2014 a non-executive director, and now will be pretty much more active. And then we have the second one, which is Kerry Ehrman in the 19th of May, so same year, have been actually as well finished as well. He got like retired or resigned, and so I'm not sure who will replace him. I think it's the next slide. But yeah, there's a lot of activities, and it's usually not really a good sign. I mean, it shows that something is wrong with the company, and they have to do and change to kind of recover from that. That's first impression. So there's another person. So actually that was the CFO in this term is Richard Coney, and this one will be replaced by George Saud. So yeah, to be honest, usually when there's a chief financial officer that is changing, you have to be a little bit concerned in the first place, because like that's the one that finance the company, or like the accountant or something. So when it's related to finance or accounting, you just double check more further. I just want to say from experience, it's always concerning a bit, to be honest. So that person will be the new George Saud, and then he has a lot of experience, at least, which is a good thing in the industry and in retail, financial services, and property. So I think he could be the man to replace. I have no idea, I don't know enough, but just give you an idea of what he does. So now what I want to add is the fact that there've been a little bit of insider trading. So there've been a few buyers, and the major buy that is, I would say, interesting is Jack Cohen, which is now a bit more active, but he's already the biggest investor in this company, which has 24 million shares. He's actually buying another 350,000 shares, so that is not a bad sign at $15. And then there have been a few other buyers, Anthony, so I don't think he's there, but yeah, with a few shares as well. So Jack Cohen, just to give you an idea who he is, he's been already in 11 years at Domino's as non-executive, and it's an entrepreneur and investor of more than 5 decades of experience in the food and retail business. And then he's been as well handling like Competitive Food Australia, which is kind of franchisor for Burger King, like in Hungry Jack. So that's, I think, a serious investor. Buying is actually kind of a good news, and especially taking control a bit more of the company is what, at least I would say, is a good thing. And the fact that he's definitely buying shares, so that's something to follow up, let's say. This is a very quick slide I want to get through. I just want to show that the thing that I like about these companies is just that their revenues are very balanced. So as you can see in here, they're all like pretty equal. So there's no place, or like, let's say in Europe they have like 90%. They don't have that. They have such equal, approximately 33 to 5% on each of them between Australia, New Zealand, Europe, and Asia. I quite like that. So I wouldn't say this is something to take like very seriously, but it's nice to at least see that they are noticing that they're having issues with their business and something is not right, and they are considering resetting the business, so doing some changes to improve what's going on. I will show you later, but it's been a bit declining. So just want to see that they are at least aware of it. They're not ignoring it. Ignoring it would be the worst, and they're doing everything they can to recover from these issues they're having. So in terms of their fundamental, so 1.28 billion market cap, then they have PE of 141 and 11. I wouldn't take that into too much detail for now. Price to sell at 0.5, very cheap. Price to book at 1.92. I wouldn't say it's cheap, but it's not that terrible considering the brand. And then enterprise to revenue at 1.14 seems low, and enterprise to EBITDA at 14, not that great. So overall, like, it doesn't look very profitable at the moment. I think there is a reason for that. I'll show you later as well. But their revenue is 2.3 billion, and their so their EBITDA is 197 million, and they are actually losing at the moment for this year. Then the total cash is 155 million, and debt is 148 billion. I mean, this is a lot of debt at the moment, but we will go through in more detail after that. And leverage free cash flow 100 million. So to give you an idea, I think that's more what they are doing at the moment. And then the rest is nothing special. So yes, insider is 30% ownership. That's a really good sign. And then we have a 45% of institution. So if you add them up, they're already at 75%. Quite like, because it means that it's some serious. It's not like just retail. They have no idea what's going on. It's pretty professional shareholders. Quick overview of the fundamentals. So we see that there is way more liabilities than equity, so we'll go through it later. It's not exactly just debt, so that's not as bad, but it's still like that is still significant. Then we have a balance sheet overview, so it's not doing anything special, to be honest. Liabilities is a little reduced, but it stays fairly equal. Equity is still a little bit higher year on year, so still a little sign, but not growing enough. I think that should be reduced a lot more ideally. Then we have the total debt in here with the equity, and then the cash. So yes, similar kind of things, like debt is a bit high, and then like current liabilities, asset on liabilities is not my favorite. I mean, usually current asset should be 2 times current liabilities, so have to be a bit careful over time with this. In terms of revenues, they're pretty consistent. Earnings a little bit low sometime, but overall it's fairly consistent as well. And usually retail is like that, to be honest. Then earning per share overview, so that seems to be a bit going down, so this is not a good sign. Seems like something is off. As you can see from here to there, it's pretty much going downhill, so this is concerning. The cash flow overview, it's all right, nothing special, fairly reasonable apart from 2022. And then the capital expenditure are reducing. This is a good sign. I like to see that. Actually, cash flow to me is more important than earnings, because it shows really the cash coming in. And the share issues overview, this is not great to see. Like we've been from 85 to 94 million share. It shows that they're devaluing the company. Not ideal. So in here, all I wanted to show you guys is the fact that the long-term debt is not 1.3 billion like said before, because I was taking the whole liabilities. It's only 855 million, but then you have lease. So lease is like I think some rental part, but they have to add it in liabilities that they may pay or they have paid, I forgot, or they will pay in the future. So all you take consideration for the debt is really 855 million, which is there. And then we have a free cash flow of 100 million, that what I was showing before. So just a quick calculation, per year it will take 8 years to just pay back the debt. So I'd say to me it's a little bit in a way not ideal. I would prefer to see they pay back a bit faster, to be honest, but it's possible. It would just take them, let's say, 4 years to be more comfortable, and the price to book at 2. That means you don't have much like kind of, if there is a problem, you don't have much margin of safety, because the price to book is already twice as expensive as it should be. But you know, it's not a big deal, but it's concerning a little bit. I thought when you look at the dividends, you can really see what's going on. I mean, you could see a really high growth here, really good until 2021 in here, and then since then they've been falling and are not even paying the franking credit. So in this case, that is concerning as well. You can see that they've lose like 60% of their dividend. As a retail is usually a little bit like there's something wrong, especially for 3 years in a row. For those that think that actually this year was negative, I just want to show you that's why that is not actually the case. They just actually added impairment. So because they've lost, from my understanding, they've lost 300 stores this year and they added only 40, so it's a deficit of 270 or 60. So that simply means that they have to reduce impairment, and it shows in the profit and loss earnings. So you think it's actually negative, but they've been actually still profitable in a similar fashion than last year, more or less. When I look at all the other numbers, they're very close, so that's fine. So I wouldn't take much consideration into that, but just to show you guys, the EBIT, earnings before interest and tax, is actually in ANZ, so it's like Australia and New Zealand, pretty high. So in here 130,000 versus, like, as you can see in Asia, that is pretty low compared to their revenue. So it looks like that Australia and New Zealand is bringing the most in terms of cash flow, and seconded by like Europe, and Asia seems to be less relevant. I think that's why they've had more Asian store closed recently, especially in Japan from memory. So it looks like as well that franchise is actually working better for them than the corporate, because in Asia they have like nearly 50% of stores that are corporate. So it's interesting because when I was doing a comparison between corporate and franchise, it looks normal that corporate makes more revenues, but in this case it's look like it's the opposite. So they seems to have good brand and seems to be more successful as a franchisee. So in this one, I wanted to add that for example, they have more assets in Asia, which is logical because they have more corporate stores. So you can see in here 1.1 billion in assets, and then quite a lot of liabilities as well, but this is very logical. So the interesting part is the fact that Australia and New Zealand, they have way more liabilities than they have asset, which surprised me a bit, but it might be because they are the corporation is actually in Australia, so it might be why. But the Europe is the best in a way in terms of asset liabilities, with more than 2 times asset on liabilities. That's it. For those that are interested into leases, so apparently they're doing something like they have some contract for 2 to 21 year lease, and then it seems to have like some different like cost depending on the years. I mean, you guys can have a look further. I don't want to go too much detail. If you're interested, they have quite a bit of information about that. In terms of technical analysis, there's very little to talk about. They've been growing really well since 2006. A little bit of retracement, but honestly nothing special. And then since like 2022, the peak, they've been going downhill really quickly. So honestly, this is quite concerning. I tend to see that on companies that are about to go bankrupt usually, but I'm talking just the chart. Their fundamental doesn't look as bad, but I don't know why like the drop is significant in my opinion. Feels a bit scary. I wouldn't say the other thing than that. It's already back to 2013, so this is not ideal, and it's not looking like it's about to stop yet. On the daily, there is very little to add. It's just really nice downtrend, and it's been continuing. Nice little gap here, but you know, it's just confirmation that it's going lower. There's a little bit of consolidation here that is not as strong, but as you can see here, it happened too, and it still fell back down. So I would personally I would wait to see what's going on here, see if the company improve a little bit, and then if I see better news and a little bit of a higher price, I think I would be interested, because I like the brand. I think it's a pretty good company overall, but I really think that I want to see how their debt is managed, because right now they're not managing the debt as well. So I let the company do its thing, see what happened with the changes. I don't think have to rush too much, because this kind of scenario takes usually a bit of time to recover. Of course I could be missing something and like price rise up, but I think it's worth looking first, waiting, because it usually doesn't come back that quickly. So in terms of the catalyst, I have seen quite a lot of retail, like restaurants, having issues overall, to be honest. Like so especially in the West, I've had a lot of done a lot of research, and I noticed that everything related to restaurant, food and all that have been really struggling recently. So I'm surprised that the big stores as well are having issues as well. I thought it would be more the small shops, but yeah, the inflation and cost of living is literally squeezing in the West, and mainly restaurant look like it. I mean, you can clearly see in this case, because it doesn't seem like they're doing that bad, but yeah, that's what I would follow. If people are struggling even more, it might still impact the business as well, and it might not even be their fault that is struggling now. So I don't know. This is something to think about. What is really the problem? So that's what I found, but I think we'll have to find a better catalyst to then, especially a more positive one, for me to be a bit more confident on the fact that they can reverse and become strong business again. So as a conclusion, I would say that the main advantages are the fact that the brand is very good. So I worked there for as a Domino drivers for a few years, and I thought it was a good experience overall. So I thought I had good feedback, quite organized company, and they have pretty competitive price. Not that just I worked there that I say that, honest opinion. So very well diversified worldwide as well. So they have revenues all over the world, and they have stores almost in like lots of different Western countries and even in Asia. So the major risk I would say are their high debt. I think they're a bit high for my taste, to be honest, because it's 800 million on a 1.2 billion market cap. I find it's still a bit high, and the fact that they have a cash flow that might be declining, but at the moment it's 100 million, seems to be more or less the same at the moment. So it will still take like something like 8 years to pay back the debt if nothing wrong happens. So yeah, maybe in 3-4 years, if they really do 100 million again, and reduce by 50% their debt, I would say that would be way safer company from then. But until then, who knows exactly what could happen. So the technical analysis as well is not good, but it's just following the fundamental issues. So we have to just monitor and see when it reverses, and if the fundamental reverse at the same time. It would be interesting to see, because they've done management change, they recognize the issue and they're not ignoring it. That's a good sign, but that doesn't like prove anything. Then the current inflation and cost of living might be impacting them. As you can see, since 2020, basically 1 or 2, they've been going down, and that's when things for restaurants started to really being impacted more than other business, I would say. So overall, I would say, because it depends, but so I'm guessing that's the reason. I'm not sure, to be honest. That's just an opinion and what I noticed. So it may reverse without that, but I think it's look logical. So I hope you enjoy the video, and see you in the next one.